Hello everyone, I'm Rachel. Welcome to the Economic Corner, where we update you on all the biggest global economic announcements. Let's get started with today's show. First up on the Economic Corner is an update on the US dollar, which took a breather today after recent gains met with a speed bump when details of last week's US jobs report calmed jitters about the timing of interest rate hikes by the Federal Reserve. The jobs report released lately showed non-farm payrolls surged by 850,000 in June 2021, as against the Dow Jones estimate of 706,000. Meanwhile, the unemployment rate increased to 5.9% as against the market expectation of a 5.6% rise. While the headline June job creation figure surpassed forecasts, the unemployment rate inched higher, suggesting that interest rate rises could be further away than markets and investors have come to fear. The International Monetary Fund has also released a projection on the Federal Reserve's interest rate hikes recently. According to the IMF, the US central bank will probably need to begin raising interest rates in late 2022 or early 2023, as increased government spending or stimulus keeps the country's inflation above its long-run average target. The Washington-based fund expects the central bank is likely to begin scaling back its asset purchases in the first half of 2022. Against the risk-sensitive New Zealand and Australian dollars, the greenback dipped by 0.9% and 0.7% respectively in the wake of jobs data, and then steadied today as the US dollar firmed. Gold prices edged lower today after hitting a two-week high in the prior session. While spot gold hit its highest level since June the 18th on Friday, it was down 0.1% today. As the greenback steadied, it seems to have made gold expensive for holders of other currencies. Another key update is from China's services sector, which experienced sluggish growth in June 2021. Due to the resurgence of COVID-19 cases in southern China. Growth in China's services sector fell to a 14-month low in June, fueling concerns that the second largest economy of the world may be starting to lose some momentum. Notably, the Kalkine Market Services Purchasing Managers Index plunged to 50.3 points in June, which is the lowest since April 2020. While a slowdown in the manufacturing sector is evident from the service sector data, some analysts suggest that pent-up coronavirus demand may have peaked in China, and its strong economic rebound from the virus crisis is starting to moderate. A bright spot in the Kalkine Market Survey was a significant easing in inflationary pressures. The survey showed input costs surged at the slowest pace since September 2020 last month. And just like China, Japan's service sector activity also shrank in June 2021. The final Jimbun Bank Japan Services Purchase Managers Index came at seasonally adjusted 48 points. That's below the 50-point threshold that separates a contraction from expansion. The service sector activity contracted for the 17th straight month, which is the longest such streak since the 27-month run through March 2010. The decline in service sector activity was triggered by COVID-19, which dampened demand at home as well as abroad, underscoring sluggish momentum for Japan. Meanwhile, an upgrade from the Bank of Israel is being closely watched as the central bank will reveal its interest rate decision today. The bank is anticipating to leave its short-term interest rates unchanged this week, despite recent inflation gains. Analysts are closely watching the central bank for decisions on extending government bond purchases and to keep purchasing foreign currency to add to its record level of reserves in order to contain the strong shekel. Interestingly, the central bank will also issue updates on its 2021 and 2022 macro forecasts, along with the rates announcement today. Now it's time for a short break. Stay tuned as I'll be back with more trending updates.
Tune in to get the latest information.
Whether it's about market movements or the currency graph,
sectoral coverage or industry news.
We cover it all on our news segments.
Be on top of the latest news
with Kalkine TV.
And welcome back. This is Rachel, your host, live from Kalkine Studios, and you're watching the Economic Corner. Before the break, we discussed an important announcement from the Bank of Israel. Let us now look at the next news. The Reserve Bank of Australia's monetary policy meeting is also on the horizon this week. Markets are on tenterhooks ahead of the RBA's monetary policy decision, as the central bank has flagged a decision on the fate of its yield target and bond purchase program. Speculations are rife that the RBA will gently rein in some of its emergency monetary stimulus to reflect the nation's powerful economic recovery. While the central bank is unlikely to move its cash rate, experts expect it to adopt a flexible approach to bond purchases. The RBA is likely to decide against rolling over its 3-year yield target to the November 2024 bond from the existing April 2024 maturity. Such a move may emerge as an ultimate finish line for prevailing record low interest rates, while reflecting RBA's continuing support for the economy to make sure the recovery is lasting. Moving on, the recent figures released by the Australian and New Zealand banking group show that Australia's labour market is staying strong in the face of coronavirus lockdowns. According to ANZ's latest data, the country's job advertisements extended their record-breaking run last month as demand for labour remained robust despite a round of COVID-19 lockdowns across the country. The job ads climbed 3% in June from May 2021, marking a 13th straight month of gains, at a time when the unemployment rate has already plunged much quicker than policymakers expected. The resilience of the country's jobs market may provide the confidence to the central bank to soothe its massive stimulus programme in tomorrow's policy meeting. Besides job advertisements, retail sales data released by the Australian Bureau of Statistics grabbed attention after retail turnover topped forecasts in May with a rise of 0.4%. The final readings on the Australian retail sales exceeded May preliminary result of 0.1% rise. While retail turnover rose significantly in May, it was impacted by the Victorian lockdown from May the 28th onwards, as well as those states reviving from COVID-19 restrictions in April. On the flip side, the recently released dwelling approvals data failed to impress, as the number of dwellings approved declined by 7.1% in May. The fall was driven by a 10.3% decline in private sector housing. However, the bright spot is that a fall in dwelling approvals followed months of gains, which still left approvals up 53% on a year earlier. Well, that's all from me for now. Keep watching Kalkine TV as we bring you the latest and trendiest market updates live from Sydney. I'm Rachel, signing off for now.